JPMorgan runs 2 NASDAQ income ETFs. Same portfolio manager, same underlying index, same expense ratio. Both pay monthly distributions. Both yield around 10%. One of them the IRS taxes every year. The other one, it can't. The difference isn't the manager. It isn't the index. It isn't the yield. It's one structural choice in how each fund collects its option premium. And most investors comparing these two funds have no idea it exists. Here's what that choice is, why it matters, and what it means for anyone building a tax-efficient income position in NASDAQ 100 exposure. I'm building a 5-fund income floor in public. Every position, every distribution, every decision documented here. Last week I published a deep dive on ROCY and ROCQ, 2 brand new JPMorgan funds that launched in March 2026. The central finding was that their call spread structure produces return of capital by design, not as a year-end reclassification, but as the default output of how they collect option premium. If you haven't seen that video, the short version is this. Not all funds marketed as ROC vehicles actually deliver return of capital. The mechanics determine the outcome, and the mechanics can be structurally different even inside the same fund family. Which brings us to JEPQ. JEPQ has nearly $40 billion in assets. It has been paying monthly distributions without a miss since May 2022. Its one-year total return, including distributions, is 30%. It is one of the most successful income ETFs ever launched. It is also built completely differently from ROCQ. Despite being managed by the same team, targeting the same index, and charging the same expense ratio. The structural difference between these two funds explains why JEPQ has never published a 19A notice, and why ROCQ publishes one every single month. In supplementation, there's a distinction that gets debated constantly. Creatine monohydrate versus creatine hydrochloride. Same compound. Same end effect on ATP regeneration and muscular output, but different delivery mechanisms. Monohydrate dissolves in water and absorbs through standard digestion. HCl is more soluble, smaller dose, faster absorption in some contexts. Most people focus on the outcome. Both increase creatine phosphate stores, both improve performance output. The delivery mechanism feels like a footnote, but the delivery mechanism determines what happens inside the body before the compound reaches the muscle. And in some contexts, gut sensitivity, timing, stacking with other compounds, the mechanism is the whole decision. The same principle applies here. JEPQ and ROCQ both deliver NASDAQ 100 income, same underlying exposure. But the mechanism, how the option premium is collected and what legal form it takes before it reaches your account, determines what the IRS does with it. And in a drip and inherit strategy, that is the whole decision. JEPQ generates its income through equity-linked notes, ELNs. Here's how that works. Instead of writing call options directly against its stock holdings, JEPQ buys structured notes issued by banks, JPMorgan, Goldman Sachs, Citigroup, Royal Bank of Canada. Those notes have call option payoffs embedded inside them. When the options generate premium, the premium flows through the note as a payment to JEPQ. The accounting consequence of that structure is that the payment is classified as interest income on a debt instrument, net investment income, ordinary income, taxable in the year you receive it. This is not a design flaw, it is a design choice. JEPQ was built to maximize income delivery. It achieves that. Nearly $40 billion in assets says investors find it acceptable. But the ELN structure means JEPQ's distributions are structurally, permanently, ordinary income. That is why JEPQ has never published a 19A notice. The rule requires disclosure when distributions are expected to exceed taxable income. JEPQ's distributions are always covered by taxable income. There is nothing to disclose. ROCQ does not use equity-linked notes. ROCQ sells a call option at one strike and simultaneously buys a call option at a higher strike. The net premium from that spread, the difference between what it collects and what it pays, flows directly to the fund. No banknote, no debt instrument in between. And because there is no debt instrument, the net premium is not classified as interest income. It is classified as distributions in excess of net investment income, return of capital, not taxable in the year received. It reduces your cost basis instead. ROCQ publishes a 19A notice every month because every month 99% of its distributions exceed its net investment income. That's not an anomaly. That's the structure working exactly as designed. Same manager, same index. One extra step in JEPQ's option collection chain, the banknote, changes the tax classification of every dollar you receive. And the data since ROCQ's March 18th launch makes the cost of that extra step visible. Over the same window, March 18th to June 5th, ROCQ's total return, including distributions, was 12.92%. JEPQ's was 6.75%. QQQ, the benchmark with no income overlay at all, returned 18.67%. JEPQ's ELN structure capped its upside. ROCQ's call spread structure captured more of it. Here's what that structural difference means inside the income floor strategy specifically. The income floor is built around DRIP, every distribution reinvested automatically. The goal is to reach a self-sustaining threshold where distributions cover at least one new share per month, and then hold that flywheel permanently. When distributions are classified as return of capital, they are not taxed in the year received. You reinvest the full amount. The compounding base is larger from day one. When distributions are classified as ordinary income, you owe tax in the year received, before reinvestment. The DRIP works, but on a smaller base. And at transfer, when shares pass to an heir, the cost basis steps up to market value at the date of death. Years of ROC basis reductions disappear. The deferred tax becomes eliminated tax. JEPQ is one of the best income ETFs ever built for what it does. If tax efficiency is secondary and maximizing current income is the priority, JEPQ is a strong vehicle. If you are building toward DRIP compounding and generational transfer, ROCQ's structural ROC delivery changes the math, and the early performance data suggests the call spread structure is also capturing more upside than the ELN approach in a rising market. If this framework is useful, hit the like button. It helps other people building the same system find this work. ROCQ is on the income floor watch list, 2 distributions in, both at 99% return of capital. The structural case is confirmed. The performance track record against JEPQ over a full year is what's missing. JEPQ is not on the income floor. It does what it does exceptionally well, but the ELN structure makes it a different tool for a different objective. Subscribe for the full income floor build. Next up is the GPIQ deep dive, which is where the distribution growth story goes deeper than either of these videos had room for. Drop a comment. Are you holding JEPQ right now? And does the ELN structure change how you think about it? I'd like to know how many JEPQ holders are watching this.